Something massive is brewing. This week is going to be absolutely wild. It's shaping up to be the most volatile week of 2026. Brace yourself for violent wicks and stop pints. March taking over, plus the CPI print, and plus Fed speak, and plus Trump's trip to the east, and plus the ongoing fuck-off war in the Middle East. This macro combo is going to completely nuke the market's rate cut expectations, and it will directly dictate that trajectory of US equities, gold, and all risk assets. The assets lighting the fuse first this week: crude oil. Right on cue. The so-called ceasefire was a complete head fake. The US and Iran talks have completely broken down. Oil bears just got played again. Oil really needs to pay attention to the pricing center of gravity. For oil keeps shifting higher, this is a textbook signature of a train that's nowhere near exhausted. So stop trading the news headlines to guess if oil has more updates. Just keep your eyes glued to the strait. Is it actually physically open? If not, every single dip is just a massive bear trap. And now let's talk gold. After gapping down the open, it's now sitting right at a critical 4,660 bull and bear pivot. But this time, the Asia session failed to pull off its usual trick, buying the dip and reaping the tire, which proved that at these levels, there is zero institutional bid stepping in to catch the falling knife. Even though gold ETF saw a massive $6.6 billion net inflow throughout April, the relentless trend in oil is highly likely to blow downside wide open again. So be aware of the bull traps. And as for US equities, I'm really not trying to be perma bear here, but this rally is getting terrifyingly vertical. I was writing this script on the trend today and chat with a few foreign traders. Most of them made money, but none of them are actually happy. They either missed the boat, got shaken out by vertical, or levered up just to catch the tail end. Everyone is drawing in what ifs. Looking at it from another macro angle, the world uncertainty index just back to its third highest level in history, even with the recent pullback. And a lot of guys are starting to draw parallels to the dot-com bubble of the 2000s. But honestly, I'd rather believe we are in the middle of the fourth industrial revolution, because this rally isn't just pure hype and vaporware. It's backed by monster earnings and rock-solid fundamentals. The stocks reaping are the pick and shovel plays, fueled by massive capex from big tech. It's just that this 75-degree parabolic slope makes it impossible not to sweat a brutal pullback. So at these levels, instead of a binary bull vs bear debate, you need to look at this purely through the lens of risk and reward and portfolio structure. For example, smart money is holding their core equity positions but layering on puts as tail risk insurance against a flash crash. If they still want to play a melt up without holding it back at the top, they are using tiny capital to buy calls to capture the upside. That way, you protect your